We're gonna do a quick recap of what we went over on the last video before the weekend and salute everything. Was that the weekend or was that Monday? I don't fucking know. A recap of my last video. I have some notes here. And those are gonna be over something that's very useful when it comes to doing this. So, quick recap. Engulfing, okay? Let's say that you have an uptrend. Okay? And then out of nowhere, it's starting to give you a little bit of red, right? And it's gonna give you one more red, and then it drops, right? Now, you obviously need it to go up if you're running calls, and if you're running puts, you just made money right here. So sell your put here, sell your put, buy your call. That's given there's resistance, you're gonna buy that call right there. And then now what you want is, you want this red candle right here to fit inside that green candle. That is your engulfing stage. This candle is engulfing this candle. And then you also have your confirmation, which is just another green candle. That's your confirmation that the market's gonna go up. And then you would have your confluence stage. So let's say it's going up, and then it's going up again, right? And here, let's add these little lines here. Now you have a little one, a little green candle, right? This is your confluence stage because the little one is basically showing you have resistance. And then it's gonna turn into a little red one, right? Then a bigger red one. This right here is indicating a downfall. It's great. Now, we got that out of the way. Granted, as I continue to learn about this shit, we're always gonna revisit things and touch back on things. You have your bullish, which means it's going up. You have bearish, which means it's going down. You have your 5 to 20% of profit. So anywhere between that 5 to 20%, you want to sell so you can get your profits locked in. Don't get greedy with this. That's how you lose everything. You have your 30% tariffs that affected a lot. And then today, S&P 500 or SPY, it was actually like climbing. And then like the biggest drop I've ever seen in my life happened. And it looked a little something like this, right? So climb. And actually in the morning it broke out like that. And I happened to miss that one because I was too busy selling another one. And I kind of hesitated. I was just like excited. Because that's the same SPY call that was holding me down for a while. Not this one. I had a whole separate one for I think it was a 622, 716, something that expired today. And so SPY, what happened was it was climbing. I was waiting for one more candle, and out of nowhere it just tanks like that. And then all day it was just a slow climb. And then it hit again with another tank. So I definitely just went to sleep after that. I'll tell you that. I went to sleep and then I set a limit sell. So that's where, let's say if you have a really busy day where it's just real shit, right? You still want to get some kind of profits. That SPY call was sitting at negative 100 plus for me for all of yesterday, and then it spiked this morning, and then after that first drop it was down, sitting between negative 80 and negative 100, just going back and forth between that. That was a very stressful moment. And so what I did was I looked at the limit price, LP, of what I bought that call for. Matter of fact, we're gonna give you some real-time information here. Let me see. Actually, that was on my other account. Can I see the other account? Babe, can I see the other account? Thank you. So, let's go to SPY. And so it was a 624 call. And we got that rolling yesterday at 2:39 p.m. So that was my one of the end of the day calls. Had I not hesitated, I would have cashed out. It hit over $130 in profit, which is fine. Shit happens. And I spent 135. Right? That's how much I spent. Here. Let me make it neater. So when I bought in the limit price, it was $1.35. So that costed me $135. And it was a good call, you know what I'm saying? It was a good call for me to do, but I ended up fucking myself over. That's on me. That's fine. I don't really, you know what I'm saying? And it was fighting. And so after I missed that big jump, which is why I say the first 10 minutes of market opening is the most volatile moment of your fucking day right there. That should be enough fucking energy for you to not need coffee. So that was the LP, and I happened to sell it at an LP of 35 fucking cents, okay? So giving me $35 at a loss of $100. Pretty simple math right there. Kind of forgot where I was going with that. But that's what SPY was doing to me all day, and I missed the green hutch. So I ended up selling that, and then I went ahead and I had bought, it was around, I don't know, let's see. I want to give you guys, the timestamps of whenever I did this. So we're looking at about 10:18. SPY had dropped down to 620. Stock price of 620. So I went in and looking at SPY's history, and due to all the tariffs and things like that, I know it's going to spike up later, right? So I bought 2 calls at 622 and about a 621. Okay, now both of these expired on the 18th, and at the end of day, we're looking at, for the 621, we're up 126, and for our 622, we are up 104, and that's end of day. You do the math there. Fuck me, I can't fucking do simple math right now. So that's 30. That looks about to be 230. But let's double check, because I don't want to fucking lie to you. Excuse me, 230 profits at the end of the day, but I didn't sell. So tomorrow morning it can either fall or go up. It just depends on the market itself. Now for some smaller things, let's step away from SPY here. It was a very hectic day. A day like this, I recommend just not being a part of the market, but sometimes you gotta do what you gotta do. So Lucid, ticker LCID, we went ahead and put a put on it for $2.05. This is a put, not a call. A put means it's gonna go down, okay? That means we're shorting it, okay? I believe. And so it's sitting at 230. But for our profits, we're looking at -$6. Why is it negative even though it went below 2.5? That's where the Greeks come in. And we're gonna get into the Greeks here in a little bit, because that all does affect certain things. And I ended up buying 3 contracts of that, which is, it's no biggie, you know what I'm saying? It's just $6. And one thing I've learned while doing this, you're always gonna leave money on the table, whether it's greed money and you just wanted to reach a little bit more, but take your fucking profits, dude. Or sometimes you have losses, right? So, Boeing, I didn't really pay too much attention to Boeing, but I ended up settling on a 232.50 call, also 718. There's a trend here with my dates I want to point out. Same weeks, you know what I'm saying? I always keep it same week, always keep it close. So it's manageable. A lot of people don't like to hold options. I'm different. That's just how I play it. It's safer for me, you know? So we're gonna go ahead and erase that. That's just what I went in on. And we are down on that for EOD. We are looking at, oh fuck, $45 right there. So we're down 45. Then Apple 212.5 is down 125, and that's for ticker AAPL, Apple call 718 again. Everything is expiring on the 18th here. Now, today is the 16th. We have 2 days left until expiry, and today we made $318, and then obviously 77 cents. But we made $318.77. That's after a little bit of sales. I recognize one thing I do is I don't really point out, you know, what makes me sell, bro. What makes me sell is morning time. I'm always gonna sell in the morning time to buy some more, and we ended up recovering from our losses. A whole nother $100 basically, because earlier today it was at 219, so we came up $99 off of that 219 profit. Now, the Greeks are kind of hard to understand, right? But they are very, very, very important. So I don't think I ended up holding that NVIDIA call. I actually think I ended up selling that. And I'm still holding this. So this is not marked out. But let's get into the Greeks, okay? If you know anything about college, you know that they use Greeks in their fraternities. A lot of the times a symbol like discipline or courage or things like that. Very deep stuff, very deep stuff. So you have Delta, you have Gamma, and then Theta, Vega, and Rho. But we don't really mess with Rho like that. That's not necessarily a P, it's more so one of these. And this is all from my notes right here. I was watching a lot of videos and talking with a lot of people. Secondly, one thing I recommend, look up Edward Jones. There's gonna be one in your area somewhere. Finance people, they're really good with that. Stocks, they do that. They are brokers. They do have knowledge. And just try and talk with them. I have a meeting with one of the Edward Jones employees here where I live next week, and that should give me a way better insight on how to think about this and approach this. So you have Delta. Let me write the names for you. You know what I'm saying? Gamma. Theta. Vega. Rho. And this is it for your Greeks. Now, your Greeks, these help you to mitigate risks and understand. You can figure out the percentage of likeliness that you're going to see profits. You can see time decay for your premium. It's like a whole nother language basically for stocks. Just a whole nother language on that one. So for Delta, here's what it measures. What it measures is the price change. This is ugly. So it's the price change of the option Delta is the price change of the option when the stock changes. So it's kind of saying how much is the price going to change at this rate. Now, the Greeks do not lock in. They are always fluctuating, but it's more so a deeper way to view the data of the market, right? And so for your call options, it's going to go from 0 to +1. And for your put options, here, let's put this here. And for your put options, it's going to go from 0 to -1. +1 for the calls, my bad. I kind of caught that right there. And that's how you want to read it. So, I don't really know. Now, it's also your probability of finishing or expiring in the money. So, 3 things. What's it measure? The price change of the option when the stock changes, or how much it's going to change. For your calls, it's going to be ranging from 0 to 1. From your puts, it's going to range from 0 to -1. Now, keep in mind, you will never have a 1. Okay, it's very hard to get that full 1 because that's just saying like 100% you're gonna get that. But it's gonna, I mean, highest I've seen was 95. You know what I'm saying, for Delta. And that also leads to, so let's put 95. That leads to the probability of expiring in the money, meaning you have a 95% chance of expiring in the money. But it can kind of be a little bit misleading sometimes. Like, I keep my options within $1 to $2 of the stock price because, I don't know, that's just what works for me. And sometimes it'll say my delta is at 33. So you don't always want to go just based off of the delta. Go with your gut. You know, make your own decisions. Now, let's move on to gamma. Okay, I'll just leave that there. So gamma, here's what it measures. We're gonna end up cleaning this up actually. It's too tight. All right, let's get everything over here. So you have gamma. All right, what does gamma measure? If you know, don't tell me. So we have W, actually, let me use a different color so that you guys can actually see, because I feel like one, seeing is believing, but two, it's important to see what I'm writing here. So what it measures is how much delta, or symbol itself, because I will begin to, write things in their symbol. I will begin to do that later down the line, maybe next week. It will change if stock price, SP, stock price, moves by $1. Now, all of this is measured in the $1, by the way. This is for price change of the option when the stock changes by $1. This is how much delta will change if stock price moves by $1. So this helps you understand better understand how your delta will shift. Deltas shift as the stock moves. SP moves. So just to better understand how the delta shifts as it moves. So if your gamma is, so let's say gamma is 10 cents, right? So if the stock moves up $1, your delta might increase from what? Let's say your delta is already at 30 cents. And your gamma is at 10 cents and your stock price just moved up $1 full. Your delta and this tells you what? It's simple addition. It's going to equal 40 cents. And this can help you kind of understand how much you will get in return. But a lot of apps already do that calculation for you, but this helps on a much broader scale whenever you're making calls for a little bit of time out, like 2 weeks plus. Excuse me. Now, we're gonna move on to theta. In my opinion, theta is the most important one because theta, it'll kill your option. It'll kill it. I swear to God. So fast. So fast. And let me clean this up real quick because, I don't know, I like organization. All right, so theta. Here's what it measures. The value of option how can I word this better? Because this is how I understand it, but I want to word it for those who don't, you know what I'm saying? No. So theta shows how much value the option will because it's not an if, it's a will, decrease every day. So your theta shows, let's say you have an option that's out for, I don't know. Matter of fact, let me finish writing this before I start y'all. Here is an example. So a theta of $0.05 means, now remember now, we're looking at all this, and you got to move your decimal points around because it's talking about the dollar, if it moves a dollar, right? So a theta of 5 equals a loss of $5 PD per day. Your contract's going to lose a value of $5. So on the first day, let's say it spiked up, and if you cashed out, you're gonna get $105. So the next day, let's say it stays still, it's going to become $100. It's very simple, but this is just a way to better understand this. Now you have to pay attention to these three main Greeks, because if you don't, you're gonna start making shitty calls, you know what I'm saying? So this involves math, this involves understanding, this involves basically simple addition with a little bit of probability, and you can really cash big. So understand one thing about options. They are an asset, but they are a decaying asset. So options are decaying assets. And just keep that in mind. So yeah, you can go on ahead and set an option out for a month out, but pay attention to your theta on that. You want your theta to be really low, so that way when it comes up to that and that stock price is rising, and then all of this is just doing Greek stuff. I don't fully understand it yet, but this is what it means. This is the building blocks of this whole stock thing that I have going on. This whole channel, everything I explain, the way I talk, it's getting better day by day, but this is what I understand from it. Options are decaying assets. What makes you make money is these two right here. Theta is the enemy of those two, but it still applies, even though we might not want it to, because it's simple math. It's kind of like if you build a house. Okay, what's the theta on that? Well, a house that is 5 years old is not going to sell at the same price as a house that is 15 to 25 years old. Even though they may have the same amount of bedrooms and bathrooms, might both be, I don't know, a total of 5,000 square feet, 2-car garage, all that fun stuff, full kitchen, whatever. Because of theta. Because why? Material gets old, worn down, things like that. Same thing for cars. You'll go out there and buy a 2012 Mitsubishi right now for about $2,000, but you get a brand new Mitsubishi today, looking at, I don't know, did I say 25,000? I meant to say $2,500, $2,500. As you can tell, I'm a little bit worn out today. If you buy a 2025 Mitsubishi, you're going to be paying $25,000. That's what I meant to say. I'm doing that a lot. So yeah, that's theta. Theta is decay. Gamma is how much delta will change per dollar. And then you have your delta, which is how much the price of the option changes per dollar. Now you have, we don't really fuck with these too much, but we're still going to bring them out. We're still going to bring them out. Vega, what it measures. Okay. Vega measures how much the option price will change for 1% of implied volatility, or IV. So what is implied volatility? Because that is a good big word that I myself hear a lot going on in the stock market. Hold on. Okay, so implied volatility is the expectation of how much a stock price will fluctuate. So this can help you understand if you're going to go call or put. This can help you understand how far out you want to put your call, your put. This can help you understand if you even want to make the option, because it's the expectation of how much the stock price will fluctuate. I know my handwriting is not the best. So how much the option price will change for 1% of IV. IV is the expectation of how much the stock price will fluctuate. Like I said, we don't really use that one a lot, but it seems like we can use that a lot to our advantage. The Greeks are nothing more than something that we need to use for our advantage. So an example would be a Vega of 10 cents means a 1% increase in IV, which in turn boosts the option by, well, 10 cents. So if Vega is 10 cents, every 1% increase, it's going to boost the option price by 10 cents. So let's say your option price is $5.33 and it raises 1%. Then it's going to become $5.43. Now, understand something about this. Everything here about all the Greeks is what? Both directions, up and down. So it all sounds good. It all sounds beautiful. But you gotta understand, bro. Let that shit tank by 5%. You're now down 50 cents. This is why your option will go up $1 and you have $100. This is why your option will go down $1 and you're down $100. It goes up by 10 cents and you've gained 30 cents. You know what I'm saying? This is why. The Greeks, it's very, very important stuff here. It's very important. So let me write down this example here about it going down with the same numbers, just so that you guys can screenshot. Let's go down 1%. It's going to become $5.23. Okay, and that is now your option price. Okay, so just keep that one in mind. Lord have mercy. Lord have mercy. Now, you have row, or that's their symbol for row. So here's what it measures. Please, excuse my child. Here's what it measures is One thing that I want to point out here is everything is moving by one. Whether it is $1 or a percentage, okay, everything's moving by one. It's calculated by that dollar price. Why? Math. I don't know. You know what I'm saying? So this deals with interest rates. We should all kind of understand interest rates. If you had a loan, a credit card, you're paying a car note, whatever. You know, something like that. So an example would be a row of 5 cents means a 1% rise of IR interest rates. So this is your example here. Row of 5 cents equals a 1% rise of interest rates. And so that will in turn increase the auction price goes up by 5 cents. So a row of 5 equals 1% interest is added, making your option price go up by 5 cents. So now we're taking this, combining it with this. So let's say that 533 goes up by 1%. You're gonna have that 543. But this also went up by 1%. So you gotta add the 5 cents to the 543. That's gonna give you 548. You know, you gotta add the theta to this, you have to do the gamma to this, and the delta to this. And that is how big money. So, I'm gonna let you look at that real quick, and then I'm about to erase it. You know, one thing I've learned while doing this and writing on this whiteboard here is the dry erasers that they give you suck. Just use a paper towel, because it works wonders. I mean, look at that. It's fucking beautiful. So let's do a summary of this. Delta is stock price change, direction of movement, there's an E on it. And it helps you for all right, and then here we have gamma. Matter of fact, I'm gonna just do this pretty fucking simple here. IR, interest rates, rarely important, like I said. Okay, now we're going to do red and blue, because that's what I grab next. Here we go with volatility. And then last but not least, that dog, gamma. Gamma's cool. Gamma's cool. Okay, so just to summarize all of this, all right, here's just a simple summary of what all of this does for you. And I'll just run through it real quick. So you have delta. It can help you figure out the stock price change, the directional movement, and the probability of in the money and price change. Gamma gives you the delta change. Okay, these are like brothers and sisters here. The delta change, the acceleration of movement, so how much movement is there, and then you have your risk monitor near expiration. So it allows you to monitor your risk as you approach that expiration date or hour of 4 p.m. Eastern time. Data shows you the time decay on your option. You have your option erosion and your time-based risk. Kind of self-explanatory in my opinion, if not. So your time decay is, if you got it for 30 days, it's gonna drop down this much by every day, so watch out for that. You have your erosion, kind of the same deal, and understanding time-based risk. So you're understanding that it's approaching more, it's gonna drop more, etc., things like that. You have Vega, volatility change, okay? Your sensitivity to implied volatility, IV, and then when to buy and sell. Okay, it's good for showing you when to buy and sell. Pro is your, wow, it's crazy. It's crazy. I really just forgot that. Okay, why? Let me write that over here. My brain's blinking. All right, Rho is good for your interest rates, but it's rarely important. It's rarely important. Keep that in mind. And for long dated options, so we're looking at 3+ weeks. Some people make their options for like a year out, bro. Me, nah, never that. So I'll let you look at that. All right, cool. That is the Greeks. We will be retouching up on those as my understanding gets better. And as we get more and more in depth into this stock ordeal. Now, my picks, okay? My picks here. Matter of fact, before I do all that, let's write up an example, right, of the Greeks. So let's see what I have here. So let's say we have an Apple 200 call, right? Realistically, you'll never catch me with one of those. Your delta is saying 60 cents. Your theta is saying -7 cents. Your Vega is saying 0.12, and then your gamma is saying 0.05. I don't know if this is cents or percentage. See what I mean? Whenever I'm like saying I don't really fully understand this, but I'm fucking trying here. So yeah, we're just gonna have this as just like kind of like a percentage deal. You feel me? Let's just rewrite that one. All right, and this is all for this Apple 200 call. For your Delta, okay, you'll gain $60 per $1 rise of the stock price. So if it goes up, an Apple 200 call, it'll go up $1. You'll get $60 for it going up $1, just from Delta. Okay, your theta here is -7. So you're losing $7 a day because of time, due to time. That's your theta. Delta making, theta losing. Keep that in mind. So your Vega, cage. All right. 0.12. So if your implied volatility IV rises, alright, so rises 5%, you gain $60. So connect this and this, that's 120 right here for your Delta and your Vega. And then you have to take away that $7 a day if you're holding this. So that'll put you at about 13 bucks right there, 113, my bad, not 13. Your Gamma, it's at 0.05. So let's say the stock price rises $1. Delta will become $0.65, meaning, and this is where things kind of correlate and they come together. What y'all doing? To give you the most money possible, I'm gonna try and do the math here from my head. It's probably gonna be wrong. So you have top to bottom, you're gaining $60. Granted, we're saying that all of this is because Apple went from, well, if it's a 200 call, 198 to 199. Everything here is gonna add up to your price. Okay, you have your 60 from Delta. And then you have, we're gonna skip theta for now. You have your 60 from Vega. And so let's add this up for a total of 120. Now we're skipping theta because let's just say this is a day trade, right? And then, so because the stock price went up $1, you now have Gamma falling into Delta, making Delta 65, right? 0.65. Wow, that's a lot of fucking money. Am I doing this right? I don't fucking know. Damn it. I don't know. We're looking at a lot of stuff. Oh, fuck, this is where I get fucked. Let me think. Huh. This is very interesting. So, okay. We're gonna tweak a little bit of the numbers here. So that way we can make sure that our math is at least right, you know? Cause I feel like that's important when it comes to this. Actually, let's just erase all this right here. You have 105 call in Apple, and the price, keep this in mind, or what it's trading at is 102. So your delta would be 45. Your theta would be, oh, that's 6. Your vega would be 10 cents, and then your theta would be, yeah, no, this is your gamma. I already did theta. Your gamma would be 8. And then we'll add rho into this. So we'll add rho just for education purposes, right? And so here's what happens. So let's say right now the stock price went up to 103. So it went up $1, right? And your delta increases. So this will make your delta increase because of this. Now keep this in mind. Matter of fact, so here, let's just write 102 SP, and then let's do 103 SP. So it's kind of like a chart, if you can see that. Your delta is going to come up to 53 because of gamma. Your theta is going to subtract 6 cents overnight. So overnight, and then your volatility increases by 3%. So let's just write this off to the side, right? By 3%. So you want to add 30 cents, okay, because you have this right here. So it'll increase by 3%, okay, and so you add, you kind of do like a 3 times 0.10, you know what I'm saying? Yeah, 0.10 times 3, and that's going to give you, so let's do the math in here. $0.30, okay? And then there's no change on the interest rates, right? So you have the total net change of this, right? So it's going to be starting with our delta here. Plus 30 cents minus theta. And so this is going to give you $0.69, right? Now, here is a little bit of information I forgot to throw up here. Your call was $2. A contract. So your call was $2. We'll we'll do option was $2. So you paid 200, okay? And so this is why this is important right here, to know what you paid. Because now you're gonna take this net change here of delta, vega, and theta of 69 cents. You're gonna take what your strike price was. Not strike price, this is your strike price, 105. What your buy-in was, per se, and you're gonna take that, and you're gonna do $2 plus this right here, our calculations, and this is gonna give you what? $2.69. So you just made basically $69 in short. So that means that this price now goes to $2.69. That simple. That is the Greeks. Do I fully understand it? No. Notice how we didn't really touch our gamma and our rho. We didn't really touch that much, but we also understand that volatility increased by 3%. So you're gonna multiply that, and then you're gonna add all this and do the maths, PEMDAs, if you will. So, yeah, that's about it for the Greeks. And it's pretty cool, you know. Now you get to really see the numbers and put it together. So, yeah, I'm understanding this too. It's okay. We got to take our time here. And let's just do this one more time, right? We're going to do this one more time. Again, am I the best trader? No, I make mistakes. You're gonna lose. It's okay. You know what? I think blue kind of pops out. Alright, so here is our trade. Okay. The current price. So here's our stock option, Apple, right? Stock price is 205. Our option is saying it's gonna go up to 10 strike price. So that's a call. And expiration is 3 days. This is perfect right here for the expiration to be 3 days because it's kind of what my trade window is. It's 3 days. So your premium is $1. That's your buy-in, but premium is the word. It's $1. So the Greeks for this contract: delta, gamma, theta, vega, and rho. Your delta is here, so we don't get confused and think things are negative here. So your delta is 0.35, gamma 0.08, theta -12, vega 10, rho 0.01. So let's say this is all the information that we have when we made our pick, okay? And we're gonna go ahead and do, actually I'm gonna leave that in blue here. We're gonna write everything for it going up in green because green means money and money means up. Oh no, green means money. Yeah, and money coming in means, yeah, whatever, fuck it. So let's say the stock moved up by $2. Stock price went up by $2, okay? our IV move is 0. Implied volatility, right? So this is, oh no, right here. This moves by 0 all the way through. Okay, 0%. Our change from delta right here, because it went up $2, right? So let's do some math here. You have 0.35 cents times 2 equals, well, pretty simple, 70 cents, that is. And then our change on Vega is 0. We just did that there. So this equals 0. And then you have your theta is still -12. Taking your option, actually we gotta add all this. I'm not bad. Wow, I don't, 70 plus 35, no. Okay, so the stock moves $2. IV moves none. The delta, because it went up $2 instead of $1, that gives us our 70 output. And then, oh, right here. So -12. So you take this right here and you do -12, right? So minus 0.12 for what? Our theta. And that's going to give us a total of 0.58. So you take that option and you want to add it to that. Remember, our premium was 100, okay? And so our new premium is $1.58. In other words, you just got $158 right there if you take your profits. That is for it going up. Notice we didn't really mess with rho, and gamma is kind of self-explanatory here. That's where you get that 0.8. And so that's for it going up. Now let's do it for going down. Okay, and we're gonna do down $1. Let's get my calculations here. So all these same numbers, okay, but here's the difference. Down $1. Stock price down $1. Our implied volatility is 0. Our change from delta is down 35. Change on Vega is 0 because implied volatility. Our change on theta is still -12. So you take all this and you do the -0.35 and you combine it with the -12 for a grand total of -47 cents, or -0.47. Lord have mercy. And so that's going to take your option. Remember, our premium is 100. So you take your premium price and you do 100 minus 47. Because remember that. Why are we moving the decimal? One contract is equal to 100 shares. That's right. One contract is equal to 100 shares. That is why you want to move your decimal points. Okay? Keep that in mind. Keep that in mind. Keep that in mind. So, math. Right? We all fucking hated it in school, but it's very important. It's helping me make money. And that's going to give you a grand total of 50 fucking $3 dollars. So you just lost, right? And your new premium went down from 100 to 53 or 0.53. Okay? This is where you would do a put. So if you're reading this like this, you want to do a put option. And this is going to be your call option. And then let's say we'll just strictly move around with volatility, right? So let's say volatility is going to go up 5%. By 5%. Okay? The stock moves. It doesn't move actually. It's just the same. So it's 205. IV. Goes up by 5%. The change in delta, none. The change in Vega, you take that 0.10, you multiply it by 5 for a grand total of 0.50 or 50 cents. You apply your theta, so you have your 50 cents. With theta, you're gonna minus 12 cents for a grand total of positive, we're not negative here, 38 cents. Making your premium go from $1 to $1.38, and then you multiply that by 100 for 138. So this is strictly for just volatility moving, and just kind of understand that a little bit. And then one more that's going to be a little bit in the way. Actually, I don't want to erase any of this. We'll write this one right up here. Let me see if y'all can see it. Oh, perfect. You can see the whole board. Good deal, good deal. So, let's do stock price goes up by $1. And let's do implied volatility going down 3%. Okay? So, here we are. Stock price 206. Okay? The IV, IV, negative 3%. Your delta is what? It's positive 35 cents. Okay? Your Vega, your Vega is negative 30 cents. That's where things are clashing. This is where things are clashing. Okay? And then you have your theta. Always, theta is what? It's over here. Negative 0.12. So, This is all going to give you, wow, 35 minus 30 gives you 5 minus 12. 5 minus 12, so this right here gives you 0.30. No, it doesn't. It gives you 5. What the hell? 0.05 minus 0.12 for a grand total of 0.07. Okay? Negative. Negative, 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 negative. Negative, negative, negative. Alright? And so what this is going to do is your premium, okay, right here. Is going to become, so let's take that dollar and we're gonna subtract 0.07 for a grand total of 0.93. This is for the stock price moving up, but volatility going down. So things kind of clash here. You still lose on your premium. Okay, again, multiply that by 100, and that's gonna give you $93. Sometimes this happens a lot, and you just want to take that loss right there and then throw it back in on a later date. So you have a couple of examples here. This is for the stock price going up $2. This is for your stock price going down $1. This is just for your volatility move going up by 5. And this is for the clash. Now we're mixing things here for your stock price going up $1 and your volatility going down by 3 cents, 3%. So that's why from here, where we bought it, okay, Vega was at positive 0.10, all the way down to negative 0.30 because it went down by 3%. I'm gonna let you take a look at that and take that in. You know, one thing that I do gain from doing this, these videos is I learn as I go about this shit. You know, like y'all in the video, you see me struggle with it. I'm looking down at my fucking phone and I'm Googling shit because we're here to fucking learn, dude. I'm not here to act like I know it all. And I learned. I got it to make sense to me. You know, it's really, at the end of the day, just simple math. Okay, just simple math, decimals, everything's 5, 1. 1%, $1, whatever. And that's how you can do the math. Let's go ahead and clear this up. Okay. Finally, we are going to go over my picks for the rest of the week. I don't plan on buying much more unless I have a shitty ass day tomorrow. And then I'm gonna have to do what I call the clutch and pull. If you played COD, you know what clutching is. So, it stopped? 10%. Did it stop recording?
I don't know. I don't think so. No.
When did it pop up?
I don't know. It stopped just now.
Like, so it just popped up. After I cleared all that?
Maybe. It could have been there.
I don't know, maybe. Okay. Maybe just hook it up real quick, babe. I hope that shit didn't mess up. Oh my god, I just wasted so much time, didn't I? Okay, so my picks are all for 7/18. We have Spy, Spy again, Lucid, Boeing, and Apple. Alright, so the only put I have in here is Lucid. Everything else is a call. All calls. Okay. 621. 622. 25. 232.5. 212.5. These are my picks. Again, we have like 2 days left on them, so it is what it is. Where we stand, okay? -6, -45, -125, +104, +126. This is where we stand at the current EOD, and this is going to push us to kind of want to look at things, right? So let's look at SPY, and it's done a lot of movement today, but we're more focused on the end of day movements here. Not looking too bad. So we ended up dropping, and we're still up. SPY ended up dropping at EOD, and it came up just a little bit and then canceled out right there. So this tells me there were a lot of people taking profits, and because it dropped, it's going to skyrocket tomorrow. Hopefully. That's all I'm predicting. And so let's go and take a look at Lucid. Lucid is very small. Lucid is very small. There we go. Lucid is very crazy. It does one of these right here. Ready? That right there is a saw. And when you get into music production, it's still, called a saw. But that's what it does. And then it came up at the very end. Okay, and then guess what? Canceled out because of end of day. So that is a goddamn gamble if I've ever seen one, because wow. Now, Boeing. Today we were showing a smooth slope down. Actually, a little bit rougher than that. And then we came here in a smooth slope up. And then that kind of does one of these, okay? And then this is end of day. And Boeing, I can't really, figure it out of what exactly it's gonna do. It's been doing this all week. Hopefully it comes up maybe just a little tomorrow, and then we can take profits, because that -45, you don't want to lose. And then last but not least, well, obviously it's least, but Apple. Holy shit, Apple does a lot. It was very crazy today, very hectic, but we're more focused on EOD. Very ugly handwriting right there. Apple, at end of day is gathering about the last 2 hours or whatever. We drop, come up a little bit, and then a slope with no signs of recovery right there, and it cuts off. So similar to SPY, I expect this to go up because it's down. That's the trick. Boeing can go either way. I'm looking for Boeing at about a 10 a.m. pullout. For my time, that'll be 11 a.m. So that's 3 hours. 2 hours after market opens, not 3, it's 2 hours. I'm looking for a pullout on that because I think it's gonna struggle a little bit in the morning, but obviously that's why you wake up and you watch it. And other than that, that's gonna be it to wrap things up. And yeah, hopefully the video didn't mess up. The tablet was on low power, and that's my fault. So thanks for watching. Fucking give me a call after you view this video, or email me if we're not even in touch and you come across it for some reason, and we can really work some things. But this is where I stand as of today, on the 15th, 16th, on the 16th. So 16th recap. That's what I call this, the recap. Okay. And just keep in mind implied volatility, and then interest rates a little bit of fun stuff here going. Keep all that stuff in mind. Other than that, appreciate it.